Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go until the closing bell. And stocks right now, they are broadly lower. The Dow's down about 110 points. Your broad gauge, the S&P 500 is down about 0.3%. The NASDAQ also down about 0.3%. Your small caps, they're peeking into the green. They're up about 0.1% here. Let's welcome in now. We got Barron's senior market analysis writer, Paul LaMonica. We got our data and markets editor, that would be Jared Blickery, and our Fed correspondent, Jen Schonberger, all joining us here to break down the headlines. We're going to start off coverage with you, Jared, for a look at today's trading action.
Thank you. Well, let's start with the major indices. The Dow is down today. In fact, all three of the majors are down. Dow was just barely positive Tuesday and Monday afternoon into the close, but so far we are in the red today, as it's been all day long. Now, the NASDAQ has been negative every single day this week, so this will be the third straight for the NASDAQ Composite and the NASDAQ 100 here. And for the S&P 500, which is down about 1/3%, all the majors down 1/4 to 1/3%. This will be the fifth straight down day, so a little bit of a losing streak that we're working with right here. And let's skip on down to the bond market, where we see yields heading higher, at least on the longer end of the spectrum. 4.33% for the 10-year, that is up 4 basis points from yesterday. And for the 30-year, that is up to 4.92, up 2 basis points. And also, I should add that the U.S. dollar index also creeping higher today. And that is the highest it's been in a few weeks. So something to keep an eye on there, but nothing of too much concern. And let's look at the sector action. I've been talking about streaks. Well, guess what? We have some winning streaks from the three in the green today. Energy, materials, and healthcare, each of those is up 3 days straight. And if you look to the downside, staples, one of those defensive sectors that was doing well over the last few days, that is leading the way down today, down 0.9%, followed by consumer discretionary. We got Walmart in there, and then real estate and tech. And let's take a look inside the NASDAQ 100, where we can see a mixed picture with the mega caps, but more red than green. Alphabet and Microsoft just barely in the green there. It looks like Broadcom down almost 1%, and Meta really leading the way down off 1.33%. And I do want to show you the Dow, because I mentioned Walmart there. That is leading the way down in the Dow. That's down almost 5%. But some bright spots besides Microsoft, we got three healthcare names, not Chevron, United Health, Merck, and Amgen. Each of those up. It looks like Merck is up about 2% right now. And let's skip on over to a look inside the tech sphere. We're going to go to semiconductors, then we're going to go to software. You can see it is a red board. Tech has not been favored this week. Couple of exceptions. We got ARM and analog devices. Those are both in the green today. And then looking at software, aside from Microsoft, not a lot of green there either, but you're also not going to see a lot of dark red. So another day of giving back some gains, but also some of that rotation that we've been seeing.
All right, and markets closely watching the Federal Reserve's annual Jackson Hole Economic Policy Symposium. Investors will scrutinize Powell's address. Jen, what can we expect from that speech?
Hey, Josh. Yep, all eyes on Fed Chair Jay Powell and whether he will signal a rate cut for September when he gives his marquee speech Friday morning here in Jackson Hole. And the question really on the table is whether he still sees that the central bank will remain in a wait-and-see mode given hotter than expected inflation data that we saw last month, or whether that weaker than expected jobs report will sway the Fed to open the door for a rate cut. Not all Fed officials see a rate cut next month. I spoke with Cleveland Fed President Beth Hammack and Kansas City Fed President Jeff Schmid earlier this morning, who told me this.
I think that there's a lot of data we're going to get between now and September, and I walk into every meeting with an open mind about what the right thing to do is. But with the data I have right now and with the information I have, if the meeting was tomorrow, I would not see a case for reducing interest rates.
I have a belief that we still have a long mile yet to get inflation toward the 2%. I think there's a lot of data for me that would say that we're leaning more toward a 3% inflation rate versus 2%. And I think the cost to the American people is pretty consequential.
Schmid implied that the weaker payrolls number that we saw may be temporary. In talking with contacts in his district over the past couple of weeks, he said that they struck a more optimistic tenor, implying that perhaps we could see job growth bounce back over the coming months, though he did indicate that if we were to see job growth go negative, he may change his stance. Listen.
I think the data coming between now and the September meeting is going to be very consequential. So if we do see patterns and risk to the labor market itself, I think we'll start to consider and weigh the inflation data to the labor data.
The remaining inflation and jobs reports that we will get between now and the September FOMC meeting will be the determining factor. And Josh, it could be down to the wire.
All right, thank you, Jen. Paul, I want to get you in here as well. All eyes, Paul, as Jen was just saying there, on the Fed. What are you going to be watching for?
Yeah, I think we are, the market is hoping that Jerome Powell starts to sound a little bit more dovish, but we had those comments from Beth Hammack this morning, increasingly hawkish or still at the very least worried about inflation. And don't forget what companies are saying as well, Josh. Walmart reporting earnings this morning, talking about the impact of tariffs and what that is doing for prices at the world's preeminent retailer. That isn't great news. I think the combination of some of the Fed speak today and Walmart really is what's dragging the market down today.
But I was going to ask you that, Paul. Do you think some of the weakness we've been seeing in the market, and listen, you don't want to overstate it. It's August, it's thin trading, not a lot of people around, but do you think it could be because, listen, the market's growing less confident, Paul, that cut is indeed locked in next month?
It's possible. I mean, we've gone from more than a 90% probability of a rate cut on the Fed funds futures a week ago down to like 75% or so. So there's still very high expectations for a rate cut. I think we can't underestimate, though, the fact that all of the major indexes recently have hit new record highs, which if you had said that in April, that we would do this in August, I think a lot of people would have thought you were crazy in light of the Liberation Day sell-off. But here we are. So it is healthy to have a bit of a pullback for the Dow, S&P, and NASDAQ. And it is that seasonal factor as well. August tends to be a tough month. September, unfortunately, is the worst month for the market. So whether or not we get more downside ahead remains to be seen. But, this isn't, I don't think, that big of a surprise given both the seasonality, the fact that we have record highs, and what you're now hearing from Fed members about inflation and rate cuts.
All right, we'll be watching carefully. Thank you, everyone. Well, pressure coming down on the Fed for policy changes. Expectations point towards a Fed rate cut in September, while President Trump continues to call for a big cut to rates. However, while markets look for a glimpse of a dovish tone from Fed Chair Powell, our next guest believes the Fed should remain on hold for the remainder of the year. Calvin See, BNP Paribas head of America's macro strategy and U.S. economics, joining us now to discuss. Calvin, it's good to see you. Let's start, Calvin, with what we expect tomorrow. We're very wound up, Calvin, about tomorrow. I don't know if you've noticed, all eyes on Jay Powell, Jackson Hole. What kind of Jay Powell are we going to see? Right? Is it neutral Jay? Is it dovish Jay? Do we get a hawkish Jay? What do you think?
Well, that's the million-dollar question. Mm-hmm. We have been amongst the most hawkish banks in the street, calling for the Fed to remain on hold ever since December of 2024. That's been a challenging call to hold, especially as we've just mentioned, the markets have been really sticky on pricing in September at an extraordinarily high probability for a cut.
Go ahead, Calvin.
Jay Powell has told us, however, that he has a very clear reaction function. And the two things that he looks at is the year-over-year rate of PCE inflation and the unemployment rate. Based on that reaction function, the Fed should not be cutting rates in September. Therefore, what I think is the most important thing to be watching out for tomorrow morning is whether or not Jay Powell shifts that reaction function. If he stands pat, which is our base case, continuing to highlight that the labor market still remains tight given the unemployment rate, we think that a lot of that cut pricing can come out of the curve and push interest rates higher.
If he stands pat, Calvin, your base case, how does the market respond?
We think it will respond in a couple of ways. The first is we're probably going to see those September probabilities come down from those about 75% chance right now to maybe somewhere closer to 50-50. And what we think was also going to happen is that the yield curve is probably going to flatten quite significantly as well as the front end rises relative to the back end.
All right, Calvin. Paul, Calvin says stand pat, base case. What do you think?
Yeah, I mean, it's obviously going to be data dependent, to use that sort of trite saying, and we have some jobs numbers, some more inflation data that will be coming. The thing that I'm really struck by is that we talk a lot about hawks and doves. To use another bird analogy, Jerome Powell, as we all know, is a lame duck. He's not going to be the Fed chair for a third time. President Trump is going to nominate someone else potentially sooner rather than later. So I think the big question is, if Powell's trying to cement his legacy, how cognizant is he going to remain of last year's arguable mistake in cutting rates aggressively because they were worried about some of the data? And then it turned out that inflation, kind of like the guy in Monty Python who's saying, I'm not dead, I'm not dead. It still is something that they have to worry about. So I do think that there's a chance Powell sounds a little bit more hawkish, and we can't cement that September rate cut just yet. It's going to be about the data, I think, more importantly than anything Powell has to say tomorrow.
Calvin, if they don't cut in September, though, I would expect a mushroom cloud to go off at the White House. I mean, can you imagine President's response and reaction if they don't cut? Does that matter?
In a perverse way, given the pressure that Trump has been putting on Powell and headlines that we've heard recently with Lisa Cook trying to basically force her off of the board as well. I think that's, in many ways, talking about Powell wanting to cement his legacy makes him want to even be stronger in the face of all this and to make the right decision based on his framework rather than buckling in and just doing the cut simply to get the monkey off of his back and doing it because the president's telling him to.
What about, Calvin, there's another school, I want to get your take on this, that I know we're focused on tomorrow with the speech at Jackson Hole and the cut next month. So, some folks say, as investors, should we be looking past that? That longer term, listen, Trump is putting a lot of folks there. He's got Bowman and Waller, Moran nominated. He's going to have a new Fed chief by next May. It's a lot of Trump folks. In other words, you're getting cuts, right? And shouldn't you just, as an investor, focus on that rather than just tomorrow or next month?
I think what markets really care about and why timing is important, because if the Fed starts earlier, it's clearly showing a shift in the reaction function, that they have now become much more worried about downside risks to the labor market rather than fighting inflation as the primary goal. What we learned from the minutes yesterday is that inflation is still the primary fight that they should be concerned with. We agree with that. Our research suggests that in the next few months, we could still have a lot of inflationary pressures coming through the pipeline as those tariff-driven impacts finally begin to bite. So if the Fed cuts too early, we think once the Fed starts cutting, the markets are going to price in potentially even more cuts. And that could be worrying for the Fed, because that could result in a situation where they lose control of the inflation fight, which, in my view, is the bigger of the two problems at the moment.
On tariffs and inflation, Calvin, it sounds like when you listen to our policymakers, the big debate seems to be about whether you think that is, one time, it's then going to ease, it's going to be transitory, or are you in the, no, this could actually be persistent. Where's your guys' base case on that?
We have been very early on this theme. We wrote numerous papers from last year to this year talking about how concerned we are about inflation. We think that tariff-driven inflation in this environment could be significantly more sustainable than it was, for instance, during Trump's first presidency. And the reason we say this is because inflation expectations today are much less stable than they were before. So in our mind, in an environment of a still very tight labor market, we could have second round effects of inflation begin to occur. And this is already being evidenced through the data. If we look at the latest CPI number, people dismissed it because it wasn't that high. But what are we seeing? We're seeing services inflation already begin to look quite perky, suggesting that tariff inflation is not just limited to the impact on goods, but it might be spreading more widely through the economy. Another reason why we think the Fed should be very careful and resist cutting rates too soon.
All right, Jay Powell, Jackson Hole, we're all going to be watching. I know you will be too, Calvin. Thank you, sir. Appreciate it.
Thank you.
Well, the U.S. and the EU mapping out their next moves on tariffs with steel, aluminum, and other trade policies on the table. The outcome could shape costs for manufacturers, supply chains, and global trade flows. Investors watching closely. Daniel Hamilton, Senior Non-Resident Fellow at Brookings Institution, joining us now. Daniel, it is good to see you. So the U.S. and the EU, Daniel, they released this statement. We get more details, Daniel, more specifics about this trade agreement. I guess bottom line, is this a win for the U.S., Daniel? I did hear Peter Navarro today. That is Not surprisingly, perhaps, Daniel, how he's framing it. It's a win. He was saying how, listen, Europe is going to reduce their tariffs to zero. The U.S., he says, still applies a 15% tariff to nearly all European goods. Is it a win for the U.S., Daniel?
Well, I think it's a win for both sides in the sense that they maybe move on to other things. The EU is our biggest trade partner. It's a $9.5 trillion transatlantic economy. And if we're fighting our closest friends on all these issues, we're not taking on bigger challenges like China. But it's important to note, they signed a political agreement in July. This is now what they call a framework agreement. So it's actually not a done deal. There's a lot in the words in the statement. It's a lot of we intend to, we plan to, this is just the first installment, but the basics are out there. The U.S. Is getting a pretty good deal here. The EU is going to, eliminate tariffs on all U.S. industrial goods. It's going to give preferential market access to seafood, U.S. agriculture, not chicken or beef, because the EU has problems with how we clean our chickens and what we do with our beef. So that's still a problem. It has pledged to buy $40 billion worth of AI chips. It's pledged to, over the next 3 years, $750 billion of energy for the United States. That's 3 times what it does right now. So hard to see how actually they're going to actually do that. It has said it's going to buy more defense equipment from the United States, and it's going to invest more in the United States. A lot of those decisions, are made by companies, not governments. So these are sort of, vague kind of promises. So it's, you have to pin them down on that. On the U.S. side, as you said, the EU has agreed to eliminate tariffs on all U.S. industrial goods, and the EU is going to get a 15% tariff on its exports to the United States. That includes, most favored nation tariffs. So the tariffs we've already negotiated over history with the EU are now part of that 15%. This is the only deal that the U.S. has signed in the world at the moment that includes the MFN, the most favored nation tariffs, the rich, legacy tariffs in the 15%. So that's breaking some new ground. Aircraft exports of EU, aircraft to the U.S. are exempt. Generic drugs, pharma to the U.S. are exempt, and some other things to be determined. There's a little complication on auto tariffs right now. Trump slapped 27.5% tariff on European auto exports to the United States, but said it'll go down to 15% when the Europeans introduce the legislation to move forward with this deal. And it's retroactive. So if they'll do it this month, still in the next week or so, then it's retroactive to August 1st. So the 15% tariffs on EU autos to the United States could still come into play as of August if they introduce this legislation. So that'd be the next step. So, on balance, it's a good deal, but it's really more the first installment in just endless negotiations about all these details. And as I said, the EU actually has to go through a long process through its own parliamentary procedures. It has 27 member states. They have to pass all this stuff. So this is going to go on for, some time. We shouldn't anticipate there's some sort of neat document here that just moves everything forward.
It's interesting, Daniel. On pharmaceuticals, it sounds like those are capped at 15%. What's interesting to me is in part how perspectives can kind of shift, Daniel. Like if I told you a year ago you would have those tariffs at 15% on European pharmaceuticals, you might have been, maybe you've been surprised or shocked. But now, hey, it doesn't sound as rough as maybe it was first estimated. I wonder, is that sort of a sign of the art of the deal here, Daniel? Initially you come and you kind of threaten like coming at you with an Abrams tank, but at the end it doesn't sound nearly that scary. This is
Donald Trump's art of the deal. He gets in your face. He threatens nuclear war. Basically, he's going to blow you out of the water. You get a little nervous so that you take a deal that you never would have agreed to, earlier, and then you tried to say, well, that was not so bad. But the EU has come under huge criticism in Europe for signing that political arrangement. And I bet over the next couple of days, since the agreement was just released today, you'll see a lot of criticism in Europe again that the EU is buckling to to Trump. And so it's not really a done deal. As I said, they got to go through 27 countries' parliaments. They got to get the European Parliament, which represents the whole EU, to agree to this. The head of the Trade Committee in the EU Parliament is not a fan of this. So there's some rough water still going ahead.
Dan, thank you so much for joining us today. Appreciate it.
Okay, thank you.
We are just getting started here on Market Domination. Coming right up, the world's largest Bitcoin treasury company may be in decline despite digital assets having a very strong moment. I'll explain when we return. Plus, Hewlett Packard is having a good day. We're going to tell you what's pushing that stock up. And Instacart is getting a delivery of bad news. What will it mean in a tight war on grocery apps? We're going to have that story and a whole lot more coming right up. Now time for some of today's trending tickers. Barron's Paul LaMonica is right here with me. We're taking a look here at Strategy, Hewlett Packard Enterprise, and Instacart. First, going to start with Strategy, company formerly known, of course, as MicroStrategy, seeing shares sliding as one analyst sees more struggles ahead for that name. And Paul, so Strategy, a levered play really on Bitcoin, and I'm reading in Barron's, that august publication. And what your house is talking about here is they kind of detail the drop in the stock of the past month, and they cite an analyst from Menez, Crespi, and Hart, Paul, who reiterated a sell, that market cap to Bitcoin multiple bound to decline, in part, Barron's pointing out here, because of the credit market skepticism of the debt that Saylor's companies issued to finance some of its purchases. What do you make of it?
Yeah, I think there are legitimate questions and worries about how much debt Strategy, MicroStrategy, whatever you want to call it, is taking on to buy this massive amount of Bitcoin. And at the end of the day, you can be bullish on crypto and then you can buy Bitcoin, or you could buy the IBIT ETF. You don't necessarily need to buy MSTR, which now has really de-emphasized its software business in the name of becoming the preeminent Bitcoin treasury company. As you said, it's very leveraged to Bitcoin. It's going to be incredibly volatile. And as we've seen, Bitcoin is still an asset that is incredibly, fluctuates very wildly. So that makes it difficult, I think, for investors to have any confidence that MicroStrategy is going to be nothing but as volatile as Bitcoin.
Yeah, down there. We should know, Wall Street loves this name, Paul.
They do.
90% have a buy on this one. Not many skeptics on the street.
No, and there's something to be said for what Saylor has done to make them a kind of tertiary enterprise software player into the world's largest Bitcoin treasury. You do have to take off your hat to that, but it's just a very expensive and risky company.
All right, let's move on to another one. Hewlett Packard Enterprise getting a lift over at Morgan Stanley. The firm upgrading that stock from equal weight to overweight, noting upside to earnings. So Morgan Stanley, Paul, okay, they take HPE to overweight. They're believers. Target 28. Sounds like next earnings announcement, September 3rd. The analyst is looking forward to the analyst day, though, too, here. Says, given we are likely to get, he says, longer-term forecasts that could help the market more clearly appreciate HPE's future earnings and cash flow power. Analyst saying here he favors HPE and Dell into earnings. What do you think?
Yeah, I think HPE, there's a lot going for it. It also has that kind of AI wind at its back. But HPE buying Juniper Networks, that I think is something that analysts are very excited to see how that helps the company. Juniper, of course, was a once market darling competing with Cisco. It's going to be something that I think will increase HPE's own offerings as well in infrastructure and networking. So I think that's why there's some of the bullishness there.
All right, final one. What's your take on here, Paul? That would be Instacart. Here with a downgrade at Wedbush, the firm lowering its rating on that stock from neutral to underperform. They go to the equivalent of a sell, Paul. Here's what they say. The recent expansion of Amazon's same-day perishable grocery delivery service has intensified the competitive environment. We say we recognize Instacart may carve out a specialized focus, they say, but we believe consumers will opt for more compelling and value-driven services. They lower their target to 42.
Yeah, I mean, Instacart obviously faces a formidable threat, and it already had from Amazon because of its grocery business, because of Whole Foods, but also I think Walmart, that really is the proverbial 800-pound gorilla in groceries, both buying them in the store and delivery. But Instacart does have some pretty powerful relationships with a lot of the major supermarket chains out there and other retailers. They obviously aren't just delivering from places like Kroger and what have you. They also have some partnerships with Best Buy and other specialty retailers. So I wouldn't necessarily say that it's the time to be burying Instacart just yet. There are some companies that have been able to go toe-to-toe with Amazon and hang in there. I think Instacart might be one of those.
Yeah, to your point, this is the only sell I see on the street, by the way. Most analysts still like this one. All right, the Federal Reserve Bank of Kansas City kicking off its annual Jackson Hole Economic Policy Symposium. It's coming as the pressure builds for the central bank to cut rates. Yahoo Finance's Jennifer Schonberger had the chance to sit down with Cleveland Fed President Beth Hammack and get her thoughts on the Fed's dual mandate. Take a listen.
Both sides of the dual mandate are under pressure, as you noted, right now. We have inflation that's too high and has been trending upwards over the past year. We got one report on the labor market, which is showing some signs of slowing, which is something we need to be attentive to. But the unemployment rate came in at 4.2, which is right around that maximum employment number, and has been really stable around that level between 4% and 4.3 for the past year. So when I look at the balance there, to me, it's important that we maintain a modestly restrictive stance of policy to continue bringing inflation back to target.
On inflation, you and your colleagues have been waiting to see what the impact of tariffs are on inflation. But when we look at the most recent inflation numbers, we saw a little bit of upward pressure on the goods side, but the services side started to pick up. Does that indicate to you that perhaps pressure is building for more widespread inflation in our economy? And given that we saw wholesale prices increase, is that a precursor for prices to be passed on to consumers in the coming months?
So it's something we're watching very closely. I think one of these big debates has been around what is the impact of tariffs going to be, in addition to the other policies that the new administration is bringing in, whether it's fiscal, immigration, or deregulation. And so we're trying to think about that holistically and what those impacts will be. I would say that what we saw in these most recent inflation reports, and again, we try not to make too much out of any one series of reports, we'll get a lot of data before the next meeting, is that you saw that wholesale prices were going up more significantly, but not necessarily being passed on to consumers. That tracks with what I'm hearing when I'm out traveling in the district. And I'm hearing from manufacturers that they're trying to buffer these price pressures as much as they can, but that's not going to last forever. And so some of these price pressures that are coming into the PPI and coming into the wholesale space will eventually make their way into the consumer space.
And then turning to monetary policy, you said in a speech back at the end of June that it may well be the case that policy remains on hold for quite some time before the committee initiates very modest cuts to return policy to a neutral setting. Do you still believe that?
I do still believe that. I think that we have a very small distance to go to get to a neutral set of policy. And I would only want to move into an accommodative stance of policy if I thought that the economy was materially weakening, which I'm not seeing evidence of right now. I'm not seeing any signs of potential significant downturns. And to me, that's what would require us to move into an easy stance of policy rather than our currently modestly restrictive stance. So I don't think we have far to go. I think it can be quite some time.
So that means you see holding rates steady likely come September.
I think that there's a lot of data we're going to get between now and September, and I walk into every meeting with an open mind about what the right thing to do is. But with the data I have right now and with the information I have, if the meeting was tomorrow, I would not see a case for reducing interest rates.
And you said that you see very modest cuts to return to policy. How far are we from neutral at this point? How many cuts away, if you will?
I don't think we're very far. I don't disclose my dot, but I think we're right around. I mean, my longer term rate is towards the higher level. I think the economy's been incredibly resilient. You look at financial conditions and they are broadly supportive of the economy overall. I'm not hearing that interest rates is a huge problem, and that's the thing that's been holding things back. Even if you look at the housing sector, I know people like to talk about the impact rates have on housing, but when I'm out talking to builders or I'm talking to businesses about building new plants, what I hear is that the cost of materials and labor are as impactful and as important, as much of a barrier to beginning new construction projects as interest rates.
Switching gears a bit, President Trump is looking to sort of push Fed Governor Lisa Cook out of the Federal Reserve Board. She's holding her ground. When you look at some of these actions and pressure from the White House on the Fed, how do you view that in the view of Fed independence and setting policy?
So I think of them as completely separate. I think of the way we need to set policy is to serve the American people and to make sure that we're providing an economy that meets our dual mandate of maximum employment and stable prices and offers opportunity and growth for all Americans. I try to tune out the other parts of things that are going on around us, and I would say Fed independence is critically important. There's a large body of research that shows how economies that have independent central banks have better outcomes for their economies, both on the labor and the inflation side. And then finally, on Governor Cook, I would just say that I know her to be an outstanding economist and a person of high integrity, and I know she released a statement yesterday that I would just refer you to look at.
A gorgeous backdrop sets the stage. It's a who's who of the most influential decision makers in policy and finance in Jackson Hole, and we're giving you a peek behind the curtain when we return.
Fed officials are descending on Jackson Hole for the Kansas City Federal Reserve's annual Economic Symposium here at the Jackson Lake Lodge in Grand Teton National Park, a confab dating back to 1982. Central bankers from around the world, academics, policymakers, and journalists come together to discuss the economy and monetary policy. Tonight, there's a dinner to kick off the conference. Friday, Fed Chair Jay Powell will give an important policy speech. Typically, Fed chairs have used their Jackson Hole speech to communicate an important policy message. This year will be Powell's last speech as chair, and one where he's slated to speak about the economic outlook and changes to the Fed's monetary policy framework, a strategy for achieving their congressionally mandated goals. While investors are looking for clues on whether the Fed will cut interest rates next month, Powell could use this opportunity to give a broad speech and mark his legacy. During the day, Fed officials will hear from top economists who have penned papers around a topic the Kansas City Fed has picked. This year, the theme is labor markets in transition, demographics, productivity, and macroeconomic policy. Then those papers will be debated. But it's the conversations on the sidelines of the conference that may be the most interesting, both in terms of what you can learn on people's views on the economy, as well as just learning about the person specifically and hobbies that they enjoy. Amongst the glitterati expected here in Jackson Hole are European Central Bank President Christine Lagarde, of course, Fed Chair Jay Powell, all the regional Fed head presidents, as well as the Board of Governors members. And we also expect central bankers from around the world, especially from the Bank of England and the Bank of Japan. Why Jackson Hole? Well, the Kansas City Federal Reserve learned that the best way to ensure that then Fed Chair Paul Volcker would accept an invitation was to find a location somewhere in late August where there was fly fishing. So Jackson Hole it was, and Jackson Hole it still is some 40 years later.
Walmart reporting second quarter earnings on Thursday. The company missing earnings estimates for the first time since 2022. It's been a challenging tariff landscape for the sector. Our next guest is lifting his opinion, though, on the big box retailer, navigating how to play this space with the Yahoo Finance playbook. And joining me now, we have Arun Sundaram, Senior Equity Research Analyst at CFRA Research. Arun, it is great to see you. Let's talk about Walmart here, Arun, because we did have this unusual profit miss. Sounds like a lot of noise in that number. Stock is down about 5% in today's trade, Arun. What did happen here, and what did you make of this print?
Yeah, hey, Josh, thanks for having me. Yeah, so we think the market really missed the big picture on Walmart's earnings here. They were really focused on that Q2 profit miss. But to your point, there was a lot of noise in the quarter, some one-off items that they didn't adjust from their earnings. But if you look at the underlying momentum of the business, we think it actually is accelerating from the first quarter. So we think the underlying business is doing better. And if you do strip out all the noise, you can see that the comp sales in the U.S. grew 4.6%. And if you strip out some of the one-time cost pressures in our view, operating income actually grew about a little bit over 8%. So 4.6% comp, over 8% operating profit growth. That translates into operating margin expansion. And when you're a company generating nearly about $700 billion in annual revenue, every basis point of operating margin expansion is sizable profit growth. And so we see this trend continuing for Walmart over the next year or a few years, really. And it's due to their e-commerce business that's growing really rapidly. that's also allowing Walmart to grow some newer business streams that it historically hasn't really grown. Things like advertising revenue, third-party fulfillment services, financial services, things like that. Those are high-margin revenue streams. And in fact, this past quarter, about 50% of Walmart's operating profit growth came from these alternative business streams. And I think the market is really missing that big picture here.
And that's why, when you go to a strong buy on this name now?
Yeah, we thought the sell-off this morning was a little bit overdone. And to my previous point, we're expecting strong margin expansion this year, and we think that'll continue next year. I think the market again was overly focused on this Q2 profit miss, but that was largely due to this general liability claim that they incurred this quarter. It was an accrual. It's been happening for many retailers over the past few years, actually. It's due to a lot of general liability claims, workers' compensation claims, things like that. But that impacted the results this quarter. But that's not expected to continue going forward.
I want to switch gears and get your thoughts on another name I know you cover and another name I know you like, Target. You got to buy on that one too. The news there, Arun, of course, they named this new CEO. Investors seemed disappointed, Arun. I'm curious what you made of that news.
Yeah. I think the reaction to the stock yesterday was really on the CEO news, because if you look at the underlying quarter, the results, it was quite. I wouldn't say it was strong, but it was better than expected. Comparable sales did improve from the first quarter of the year. The inventory levels at Target are much cleaner now than it was a quarter ago. That to me signals that there'll be less markdown risk in the coming quarters. Even their sales cadence from May to June to July improved each month. So I think there's some underlying strength in the business. But again, the stock was down because of the CEO announcement. And in our view, you have to give the incoming CEO, Michael Fidelki, the benefit of the doubt here. He started as an intern at Target, worked his way up to the top. He's been here for over 2 decades. And I think you have to give him the benefit of the doubt because, and on one hand, investors wanted an external CEO hire, but on the other hand, they want a really quick turnaround at Target. And I don't think you can really have both. And I think with an internal CEO change, you can potentially get a quicker turnaround at the company.
Arun, as investors, we compare and contrast Walmart and Target. In your opinion, as an analyst who covers both those names, is that still a fair comparison?
Yeah. There's certainly an overlap in customer base between the two companies, Walmart and Target. Yeah, there's differences in mix in both Walmart and Target. Walmart, predominantly a grocery retailer, consumables, staples. Target is more of a discretionary retailer, sells more apparel, beauty items, things like that. But there is a customer overlap there. But right now the discretionary environment is not great, and that's one of the reasons why Target sales have declined over the last few years, whereas Walmart sales have increased because they sell Walmart US. About 60% of Walmart's US sales is in grocery, so they're predominantly a food retailer. Whereas for Target, only about 20 to 25% of its sales are in that food and beverage category. So it's not much of a grocery retailer at Target.
Arun, finally, let's talk tariffs. I'm just curious, the companies in your coverage universe, Arun, how are they navigating that dynamic? Are there some retailers that seem to be better positioned to absorb those higher costs than others?
Yeah, so far right now, I think the broadline retailers, the big box retailers have been doing a pretty tremendous job in managing tariffs. I say that because inventory levels are in a good position for companies like Walmart and Target. At the same time, even for Walmart this past quarter, Walmart US, their gross margins actually expanded despite tariff headwinds, and despite the fact that Walmart had about 7,000 price rollbacks in this latest quarter. So they're increasing discounts or promotions while still expanding margins despite tariffs. And a lot of that is because of these alternative revenue streams I was talking about earlier. But to answer your question directly, yeah, the retailers that sell more food and consumables have less tariff risk than the discretionary oriented retailers. So a company like Target, about 50% of its sales are imported. But for Walmart US, only about 1/3 of its sales are imported from overseas. So Walmart certainly does have less tariff risks. But I think in the coming quarters, Q3 and Q4, we could potentially see more price increases. This past quarter, we didn't see as significant price increases that many initially thought, and it's because a lot of inventory front loading. A lot of retailers bought inventory ahead of tariffs, but now they're starting to replenish some of that inventory. So we could see a bit more price increases in the coming quarters.
Arun, always great to see you and to have you on the show. Thanks for joining us.
Thank you.
Coming up, that subscription to Apple TV Plus has taken a bigger bite out of your wallet. That story and more when we return. Nvidia earnings are coming up on Wednesday, August 27th, and Wall Street analysts, they're getting more bullish heading into that print. At least 9 analysts now have raised their price targets on the stock this week. One of those analysts, join me now. We have Matt Bryson, Wedbush Securities Managing Director, Equity Research. Matt, you bumped your price target up to 210. That's 20% upside from the stock's last close. How come, Matt?
I think it's a combo of things, Josh, but predominantly everything seems to have been going really well this quarter. We've consistently gotten good feedback around the current Blackwell product. We've gotten good feedback about how the ramp to Blackwell Ultra looks like it's going to go. And then add to that, finally, them being able to, again, ship some product into China. All of those kind of factors create, in my mind, revenue upside, both for the quarter they're reporting, but more importantly, going forward.
Is it too simple, Matt, to just say, listen, I just heard big tech report earnings. I heard all of them say they're going to keep spending on AI CapEx, and that's good news for Nvidia?
No, I mean, I think that's the start of it, right? Particularly Q3, Q4. CSPs have been the largest single bucket for Nvidia to sell into. If they're going to spend more and they're going to spend more on AI, Nvidia is going to be the primary beneficiary.
What about China too, Matt? And I'm just curious what you make of this potential 15% tax on AI exports.
Yeah, so it creates some interesting math for Nvidia in the sense, do you swallow that and so you're still shipping more products, still getting more revenue, still getting more gross margin dollars, even if maybe your profits getting eaten up a bit. But regardless, it doesn't matter. Numbers still go up. I think the bigger question is how much do they go up? If you remember, Nvidia said they're losing something like $8 billion, or we're losing something like $8 billion in Q2 because they couldn't ship into China. Now you've got that incremental tax, if you will. You've got China asking companies not to buy Nvidia products. And so the question that I think everyone's struggling with is, we know that Nvidia is going to get some revenue from China, but is it $1 billion a quarter? Is it $4 billion a quarter? So I'm trying to be a little bit conservative there, but it's still a better place for Nvidia to be than it had been when they simply couldn't ship to China.
You know, I know you're a financial analyst, Matt, but I guess it's kind of a broader policy question, because you look at these Senate Democrats, Matt, you saw this, I'm sure. They sent this letter to Trump. They don't sound happy, Matt, about allowing Nvidia and others to sell AI chips to China. They called this a cause for serious alarm. What do you make of that, Matt?
I think there's certainly a healthy debate to be had there. Nvidia is selling a product that arguably China can produce internally, and I think Nvidia software stack is better than what China has. So it makes it easier for China to use their products. The H20 is very much set up to be used for inference. You're basically getting output. You're probably not training anything that is going to be used in a manner that is disadvantageous to the U.S. As a financial analyst and a history major, I would tend to think that this is no more dangerous than, say, shipping Intel CPUs to China, which we've been doing forever. But I think it's a debate. Conversely, what gives the U.S. the right to put an export tax on product going to a specific geography? It's not really something I've seen before. So I think there's lots of debates we can have around current U.S. policy. As
we head into this Nvidia earnings print, Matt, and you're bulled up on the stock, you just raised your target, but when those Wedbush clients ask you, Matt, they say, okay, what are the risks I need to think about? Both in near term and longer term. What do you tell them?
I think it's really longer term, Josh. So it's you had an MIT paper out, for instance, talking about the fact that only 5% of businesses are getting value out of generative AI. And it's really, when we look forward, what is the true benefit of generative AI going to be? And that's going to determine eventually what spend is when we get past this arms race that we're in right now. Now, having said that, like you said earlier, you've got the CSPs talking about spending more money. Next year, we have all these sovereign data centers that are going to spend a ton of money. So I think there's a pretty long runway we have here where people spend money on NVIDIA chips before we have to see those benefits clearly show up to create more spending around NVIDIA product.
Final question, Matt. I want to switch gears, talk about another name you cover, which is Intel. A lot of headlines there. SoftBank, $2 billion injection. Reports the U.S. government could take a stake in the company. Does that all, Matt, does it change the Intel narrative? Does it address Intel's core challenges?
I think that it somewhat helps. The SoftBank investment certainly helps, right? An additional $2 billion. SoftBank purportedly looking at a larger deal at one point, which suggests there's true value in Intel manufacturing. But Intel manufacturing, I think, remains the question mark. So their problems over the last decade have been predominantly they just aren't competitive on the manufacturing side with TSM. And we still don't know whether they can be competitive. And it really doesn't matter if the U.S. government has a stake or if SoftBank has a stake. It's really all about them getting their process right. And we may start to get some insight into that late this year, early next, when they start releasing new products based on that process. But until then, I think it's really a question mark.
Matt, always great to see you and to have you on the show. Thank you. Apple TV Plus, the streaming platform behind the big tech firm, bumping its monthly price tag to $12.99. For more, bring in Yahoo Finance senior reporter Alec now. Alec.
Apple TV Plus getting more expensive. Starting today, new subscribers in the U.S. will pay that $12.99 a month fee. That's up from the prior $9.99. Now, current subscribers will see the change kick in after their next billing cycle, and the price hike will also roll out in some international markets. This puts Apple right on par with Paramount Plus in terms of pricing, but it's still behind some of those top streamers like Disney Plus and Netflix. Apple is framing this latest price increase around its growing slate of originals. Think Emmy standouts like Severance and The Studio, as the company really leans into this position as an ad-free and more prestigious or niche streaming destination. However, retention remains a big challenge given the lack of content compared to other platforms. You're looking at new data from research analytics firm Antenna, which shows that monthly churn rates for Apple TV Plus, that's come in between 5 and 7% over the past year. That's well above the industry average and nearly 3 times higher than Netflix. Even when signups spiked earlier this year, cancellations quickly followed. So that suggests that a lot of Apple's growth is still driven by free trials, short-term promotions. And as a reminder here, this price increase also comes as Apple is reportedly losing its Friday Night Baseball package, with rights likely heading to NBC's Peacock. So lots of changes that we've been tracking across the streaming ecosystem. We just saw the debut of Disney's ESPN direct-to-consumer platform earlier today. That represents a new era for the cable bundle, obviously more choices for consumers, but at the same time, higher prices as well.
All right, thank you, Allie. Well, while we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.